let go of all of the negative things that happened in 2020 and look forward to 2021 because it truly, truly has some incredible opportunities in store for us. With regards to the fundamental market, obviously, it's already well known that the stimulus package was agreed. $900 billion was agreed as part of a larger stimulus package, I believe, which is about $2 trillion. So we're talking another $2 trillion on top of the what, 7.5, or it's very very hard to keep track of this, but I think we're looking at about maybe 15 total trillion dollars that has been spent in the economy, and we are still getting unemployment numbers at record levels. We are still getting pretty much a lot of pressure from Main Street as we move into this what could be potentially another very serious lockdown, even worse than March. And so if you think about that, so far we have spent on this pandemic since March or this year, pretty much in the neighborhood of about, I think you put it all together, about $15 trillion if you include some of the repos that were done or are still being done right now by the feds. It is a staggering amount of money, and yet we are still going into another major lockdown. We have yet to resolve the infections or the peak, you might say, as a consequence of the holidays, gatherings, New Year's coming up, Christmas passed, and we haven't yet seen or compiled pretty much everything regarding Thanksgiving. So it's becoming a much more serious problem than I think a lot of people would like to admit, and I think it's putting in the government at a test, is that there is no other alternative but to print, and print as much money as you can in US dollar terms. It was announced this morning on CNBC that Peru, a South American, Latin American country, has borrowed what I believe is $1 trillion in a 100-year bond at about 3.25% interest rate, approximately, as I was coming on. Now, this rate tells you the urgency that now emerging countries are beginning to feel as a consequence of this collapse economically, which is only putting tremendous pressure on any US dollar asset denominated instrument, or debt, you might say. And so the rate of interest charged on this loan to an emerging country represents, I think, the crisis that we're dealing with right now with the emerging countries developing. Peru is one of them. Ecuador is another country that is potentially discussing eliminating the US dollar as their currency, which was established with Correa as the president during his administration. Now, I'm not sure where these people went to school, but if you localized your currency based on a foreign currency and you don't have the ability to print that currency, it doesn't take a rocket science to figure out that if the other currency falls apart, your economy, your system, your relationship in that currency terms is going to fall apart, which it has, and it's currently going on right now, particularly in Ecuador, because Ecuador is the only country, the only Latin American country that localized their currency in US dollars. So what is happening right now, it is beyond Main Street, beyond the average worker, beyond the small restaurants, the mom and pop restaurants, the small businesses. We're talking about affecting every sector of the economy, including our debt or our creditors' standing. And the amount of money that is going to need it to be borrowed is going to be staggering. And we're talking now 100-year bonds. So there is no other alternative but to continue to print money at the risk that, if we don't provide liquidity and solvency to the market, we're going to lose the trust and faith of the US dollar reserve currency, and that would be a bad thing for the US economy. As it is right now, the amount of money that is necessary to be printed has to be paid in some way. And the way that is being paid, or it's going to be paid, basically, is through inflation, through the devaluation of the purchasing power of the US dollar and all its assets related in US dollar. Inevitably, that is how we are financing this short-term situation. This is how the feds, the Treasury, the government is financing this fiasco by printing unlimited amount of US dollars that we really yet don't know the quantity or the amount, because they are reacting on a need basis. But rest assured that when it comes to the emerging countries, when it comes to Latin American countries, Central American countries, third world countries that are in dire strait of loans, this is what the economic summit is all about, coming up here in Davos in January, that they are going to increase the limits of the equity or the debt level to the GDP factor. The debt to GDP is going to be increased for Western civilized economies, as they say, in excess of 125, 130%. We already are in some of those areas, some of those levels. And for emerging countries, they're going to increase it, I believe, 50, 60%. And so what they're going to do basically is they're going to have to create bonds, print more US bonds, print more US dollars, okay, to lend out to these emerging countries like they are doing right now at staggering rates for sovereign countries. You're going to begin to see emerging countries borrow seriously against the U.S. with at incredible rates. And you know what? The U.S. has no choice but to honor those loans, because if not, these countries will go to China. They will go to Russia. One of the things I want to point out to you that China already is in Latin America. It already has taken pretty much control of the Amazon in Ecuador. And it's providing additional support for countries that want to move into the socialistic realm, like Venezuela. So if things get worse than they are in Ecuador, particularly, I would not be surprised that they eliminate the US dollar as their local currency and prohibit transactions in US dollars, very much like Venezuela. So what does that mean? That means that all these countries are moving to the left. They are becoming socialist countries at the risk of this economic collapse. Because, you know, the bottom line to me is that it really doesn't matter what political ideology you believe in. If the economic base is collapsing, it doesn't really matter. Look at Venezuela. They're socialists and their economy is collapsing. And now we're facing pretty much global challenging and testing of the US dollar as the world's reserve currency. And in order for the US dollar to continue to reign as the US dollar reserve currency, it has to print. And not only the US economy, but the European economy, the Eurozone, they have to unleash basically unlimited amounts of money that I believe are going to make some of these numbers that we're looking at very, very small in comparison. But where is the opportunity in all of that? You know, I ask myself. You have humanity pretty much suffering because of this economic collapse that you can't help to question whether it was, intentional or not. You question everything. You're questioning media. You're questioning what you read. You're questioning social networks. What's fake and what's not. And to me, as a self-directed individual, coming back to the markets, taking into consideration this mess fundamentally that we're dealing with right now, what keeps me straight and continue to provide the vehicle that I look for in trading is, how do I monetize out of this situation? How do I provide my family, my subscriber base, my traders with the intelligence to monetize out of this situation? Because if you put into perspective the fundamentals in terms of what is going on in Main Street, and if you take a look at the stock market, making, record highs, you kind of wonder, wait a minute, Main Street cannot be in equities. They're broke. You have about 20 million people unemployed. So what we're dealing with is two separate paradigms that has been fractured, so to speak, or divided as a consequence of the pandemic. And in March, pretty much of this year, is when we saw that shift take place, that on the face of this pandemic, where the market collapsed basically from 33.75 all the way down to 21.74 within a matter of days, from February the 20th all the way down to March the 20th, is pretty much when the stock market separated from Main Street and became a virtual economy. And since the low of 21.74 in March, we saw recently a high of 37.47, 37.48 made recently. Today, or I should say on December 29th. So there is definitely what I call an anomaly between the real economy and the virtual economy that's been created. And obviously, that you can see that in the prices, in what has kept the market, particularly the equity markets, intact, is the fact that the technicals supported the conversion into a virtual economy. It was prepared to merge into a virtual economy. What I believe was not prepared was that Main Street will be forced to move into this virtual economy completely, as the old economy collapsed, or you see it collapsing in front of our eyes, witnessing history, witnessing a historical convergence as we merge into this new economy. And along with this economy, okay, we're going to be looking at, obviously, a virtual currency. And we've been taking a look at trading Bitcoin through Grayscale, the Bitcoin Investment Trust, which is registered, and it has become extremely popular. Obviously, you can see that back in March, we're looking at GBTC trading at $5 when the market collapsed, and we're at 33. 33 from 5. That's a phenomenal move. Now, one of the things that, again, I am being asked constantly is, do you think that Bitcoin is a currency? Well, in terms of what I would say conventional wisdom or conventional terms, status quo, so to speak, not yet. Not yet. But I believe that we are in the process of making that transition where financial companies, PayPal, they are offering now new services in virtual currencies. And so I think we're beginning possibly to enter into the realm of pretty much, Bitcoin becoming accepted as a virtual currency. Now, how they structure this into the monetary system is going to be interesting to see. But one of the things for sure that I feel is coming is regulation. If we're moving into a virtual economy and we require, obviously, to have a virtual currency to go with it, rest assured that we are going to be regulated. And the question is, to what extent? And so the market obviously is breaking out. It's 33, 34. It's had a phenomenal run. And so the question is, how much more are we going to see it run before we begin to hear and possibly again begin to talk about some form of regulation? Rest assured, if we do get our governments involved in creating their own virtual currency, which is potentially what the feds could introduce here, or an alternative that may be created. So there are a lot of discussions going on, a lot of rumors going on, but again, I go back to traditionally accepting gold and silver as traditional currencies that are used in times of economic collapse. Basically, that is when essentially a fiat currency falls apart, or the value of a currency is deflated, or the purchasing power, so to speak, begins to decline. So this is a major transformation, I believe, economically, that at the same time it's causing a lot of turmoil globally. It's also creating some, again, fantastic opportunities. The same principle that I just mentioned to you, that going back to March, the gold market collapsed from 1700 all the way down to about 1450, 90, as you see here. And the high was 1704, the low was 1450. So, and this all happened within a matter of, from February, from March 9th to March 16th, in 7 days. But here you see the same thing in the gold market, that here's where the gold market shifted from becoming a commodity, which was traded as previously, into a currency, a leader. Because at this point, this is the first time that the feds announced that they would commit to printing as much money as required. And I believe they had factored in approximately 10% of GDP that they would be using as leverage to provide liquidity to the market. And so if you're looking at that number, you're looking at $23, $24 trillion that the governments are willing to use to provide tremendous liquidity to the market. And so when this occurred, it converted the US dollar into a commodity and the gold market into a real currency, which, by the way, has always been the case until 1971, when Nixon lifted the gold standard from the US dollar and the US dollar became a fiat currency. So here we saw the gold market take over and become a currency, and we saw a rally from there to 2089. Now, I'll grant you that the gold market is still under the influence of a lot of central bank manipulation, what I believe, directed by pretty much our government officials that cannot afford to have the gold market run away like Bitcoin did, okay, which is the other side of the US dollar, because that would represent that they will admit to the fact that they have lost on the economy. They have lost all control and power in the economy. And this is what you need to understand, that Bitcoin is at 30,000 because it is not a regulated asset that is related to the same principles of the gold market in relation to the US dollar as the other side of the coin, in that all of this money printing represents a deflationary consequence on the US dollar. It represents that the US dollar will lose its purchasing power as the printing presses increase its stimulus. And so far, I think we're in that 15 range, which is just unbelievable. And so we have another $10 trillion basically that they have allocated, I believe, just in case we go into a deeper implosion. But at 2089, the gold market discounted the 10 billion, the 10% of GDP number. And as I've been doing this for many years here, what I've learned is that the markets always tend to discount ahead of time. And this is why the fundamentals pretty much are lagging the market. To me, as a trader and coming from the floor, I never traded the fundamentals except to counter trend it, which was great, to do the contrarian trading against the sentiment, pretty much what the VCPMI is doing. So the gold market here at 2089 discounted what happened down here in terms of the pandemic and the economic collapse, but it wanted to see what the damage is in black and white, so to speak. And so what we have seen here is a consolidation from 2089 that brought the market down into 1767 as of November the 30th. And not only the market came down to that level, but it coincides with a 50% Fibonacci correction from the low that we made back in March at 1450 to the high of 2089. Textbook correction, Fibonacci correction completed, and the market reverted from there into this descending wedge that you see here. And by closing above it and also coming into the code of the VCPMI, it began to engage us into the long side aggressively from down here, which represents basically the extreme below the mean. And so what we have here is a combination of indicators. We have the weekly VCPMI that is telling us the sell one level is at 1910 to 1938. We have the Fibonacci trend lines that are telling us the market is breaking out from this trend line. We do have a little bit of resistance to go through here. Daily 1903, 1912. Particularly the 1910, 1912 seems to be a high level of harmonic alignment taking place or resistance. If we are able to break through that, then we're looking at 1938. 1938. And that would be the sell 2 weekly level for the rest of the week, as well as the Fibonacci trend line resistance and a Fibonacci retracement of 23.6% now from the high of 2089 to the recent low of 1767. So obviously, we are long, and we're looking for the targets to be completed. Let's go back to the 15-minute chart here. As you can see, the market inching its way up to the targets. So let's allow for the market to trade a little bit here, and let's see what happens here in the next few minutes here as the market is entering again into a holiday time. Trading above 1900 is very bullish for the gold market, and being able to hold that is given the market obviously the impetus to test that 1905 again and all the way up to that 1912, which is the sell 2 level. 1903.20 now, inching up a little bit here. 1903.20 last. Some good bidding going on. There is really no trades right now in terms of day trading, but the market on the core base positions, if you're long, obviously is gaining equity, and it continues to gain equity as the market approaches this targets of 1905, 1912, 1910, which are pretty critical levels. So we want to see, how the market reacts to those levels once accomplished, and give us a chance to recalibrate on some of the inventory that we have. $1904, 1904.20 bid, traded, 1904.10 traded. Some good bidding going on in here. The key when the market is into this area is to see how it reacts to the supply that could be offered up here, because that's what this is telling you. The algorithm tells you that the area of 1905, 1910, 1912 is a high probability area where you can expect supply come into the market. If you're going to see supply come into the market, it could be in this area, but it could be as high as 1912. Now, if we break above and close above 1910 or 1912, then it pretty much neutralizes the daily above 1912, and the weekly activates the 1938 target, which is what we are in right now. We are in a daily bullish signal with a 1905 to 1912 target daily, and we are in a weekly buy signal or bullish trend momentum with a target of 1910 to 1938. we see a little bit of supply again coming into the market, which is what the red bar represents basically, is a little bit of supply or the resistance being validated. It didn't quite get up to that 1905, 1904.40 again was the high. So it's inching its way up there. The silver market is fairly quiet here, up only 8 cents. The move has been primarily in the gold market. And even though the gold market is up, we have a little bit of an anomaly going on right now too, with the derivatives down a little bit as the gold market is up and silver is up. So we have a little bit of disparity going on right now in the mining shares that could be providing basically a great opportunity, to add to the position as the price adjusts to the physical market, to the gold market futures contract. It's indicating here basically, as you can see, the signal is coming in of a major buy one level. And so it doesn't look like the signal is coming in on the top end of the range. The silver market, SILJ, is the instrument that we also use. It's in a bullish price momentum as well. So we have the futures contracts bullish, but the shares are slightly lower here. So it's a little bit of an aberration here going on as we move into the end of this year. The one thing that I believe, particularly the market is telling me as a trader, is that you want to be careful about going short this market, even though the risk obviously is always, we can see some of this major washouts or sell-offs by the commercials or central banks, so to speak. But I think you want to use those corrections as an opportunity to build a core long-term position, because I think the gold market is going much higher than most people would think. And I believe it's going to go much higher than the previous high that we saw of 2089. So as we move into the end of this year and we're moving into the seasonality of the market, and that is essentially that in December, we usually find the bottom of the market in gold. And we usually see a substantial rally into the first leg, you might say, of the next pattern, the next seasonal pattern comes in the first quarter of the following year. And so we're looking at the first quarter of this year at about 2150 to 22 plus on the gold market as the target for the upper end of the annual target. So we still, have $200-300 room to go, and that could represent a really great opportunity for those that want to trade the long side of the gold market. Your patience will pay off. And I think we're dealing with the gold market under a different fundamental structure that we we want to take advantage of. Let's continue to watch the market here as it trades, and the volume really is kind of slowing down as we move into the end of this year, which has been a really challenging year for most of us. And I think that's an understatement. The trick here in terms of activating or looking to identify the trigger point is how the market relates to these levels and how it identifies the supply and demand. And what the algorithm does basically is it identifies for you, mathematically speaking, when that probability has been activated. And that's upon the target being completed and the market action reacting, you might say, to that on the close. So it's very specific criteria that we use, and we adhere to the discipline of following it, and not to try to second guess it. And pretty much, this is what I try to convey to my traders in my private trading room here, is that sometimes trading takes a lot of patience, because sometimes trading means not doing a trade, not having to write a ticket. Most people think that, trading means buying and selling, and, clicking and clicking and clicking, buy and sell. Sometimes trading means sitting with a position, being patient, and allowing for the market to come to you and for you to build equity. We've been blessed this year that we've been able to do that, follow that discipline that the VCPMI intelligence suggests basically to the robot, as in a written language of C++ in easy language. And so I am sharing this with you here as a courtesy, first of all, for you self-directed individuals that want to see something different, something unique, something that works. And this hour basically is a courtesy to show you, how I'm doing it, and pretty much how my traders and subscribers in my private trading room are doing it. But my traders have access to this information ahead of time, prospectively, and so we know pretty much, what to expect when the market validates or negates this information, this intelligence that we provide. So this is how pretty much you, as a self-directed trader, individual, pension fund manager, institutional trader, can use the VCPMI as pretty much as a trading tool, as a GPS to guide your trading. Obviously, you can see the market is entering a very quiet time. It's about that time now where we're going to see a little bit of a consolidation here, but it is with an upward bias, obviously. 1904.90 has been the 1905 has been the sell one level, and the market has been trying to reach this since 5 o'clock this morning. I think there's a possibility that we could see a run up into this 1905 to 1912, 1910 area. As we end this year, and then see pretty much what kind of interest we have as we come into the new year. Next week, we're going to be getting the new numbers pretty much for the month of January of 2021. We're going to be getting the weekly numbers, and we're going to be getting obviously fresh numbers for the daily. So it's going to be brand new data that is going to be available here over the next few days. Now, we're looking at the longer term data, the 360-day cycle, as I've been pointing it out here throughout this period, still indicates that we have the 1913 target yet to be completed. And this level coincides once again with the weekly and the daily levels that I just pointed out a few minutes ago. And so this 1910, 1913, 1912 level is extremely critical, extremely important as we move into this distribution area of supply. And so far, obviously, the number for this month is 1913. As we come into next month, as we do the numbers here, more than likely these levels here are going to be lowered, and we'll see what those numbers are as we come into next month. So we have a slew of data that's going to come out over the next few days, which is going to be critical in determining the targets that we want to use for the first week of 2021. Just to review here, this has been an incredible year, 2021, for most of us. It has affected everyone globally, in every sector, in every which way you can imagine, and some that we don't even imagine. And I sincerely want to wish everybody that you use this as a positive method, as a positive way for you to look at the future, to look at the light at the end of the tunnel, to look at you being in control of your financial future, to be able to take the situation, this crisis, and be able to monetize it. And hopefully that as you come here every day, once again, and you see how I apply the VCPMI, how I traded, and how I've been able to produce this phenomenal returns this year, that you can do the same as we move forward, and that you become a better trader every day that you come and see the VCPMI being traded live here in TicketTalker. I want to thank TicketTalker for a tremendous opportunity to be able to present this incredible intelligence for the benefit of you self-directed traders. Once again, everybody, thank you. Have a wonderful new year, and I'll see you there. Talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop